Shalom, everybody. Glad you're here today. Hope you're having a great day. Today, I want to talk about the economy, the federal interest rates that have been rising, and what we are doing at Valor to position ourselves to protect our assets and how we are looking at deals to purchase going forward. So let's first start about the different scenarios that we look at and see how that results would affect our purchase criteria and the investment as a whole. So the first scenario we look at is, what's the worst case scenario? Let's just say that the economy continues to show high inflation and federal interest rates continue to rise and a recession begins to really take hold. So what does that do to our view on investments going forward? Well, we know that a couple things are going to happen if that scenario is true. With interest rates rising and continuing to rise, that will variably affect the cash flow that a property could deliver as a return to our investors. The reason that is our interest rates will go up. And as interest rates go up, the cost to borrow becomes more expensive and we have to pay more money to the bank. So that is one item that we need to be cautious of when we're looking at a potential investment. How are those interest rates going to affect our property that we purchase and the returns that we're going to be able to achieve for our investors? Now, another thing we look at is, what's the refinance look like if we wanted to exit the property and get into a better deal if interest rates continue to rise? Well, that just makes it more difficult for us to get a new loan on the property and less proceeds that we'd be able to deliver back to our investors. Another thing that we also identify with rising interest rates is valuation of properties will start to diminish. If the rising of interest rates continue to go up and up and up, at some point, the valuation of a property will have to come down. The demand for the property today would be different than demand for the property tomorrow, meaning that as rising interest rates go up, the cost to buy that property becomes more expensive. And as that cost becomes more expensive, something's got to give, and that's usually the purchase price. So the value will have to come down in order to absorb those new costs so that we can generate a nice return on a purchase side. So we have to take that into consideration when we're looking at exiting a property if we buy it today. So as interest rates go up, valuations go down, meaning your cap rates go up, which drives that valuation down. Then we have to prepare for that to see, does the investment make sense for us to buy that today? So we have to be prepared as if interest rates will continue to rise and cap rates go up and valuations go down. Can our business plan by buying this property today deliver the return result that we want in the future? And are we protecting ourselves? What I mean by ourselves, that means the investment. Are we protecting the investment from those shortfalls, from those rising interest rates? And so what we do is we prepare our underwriting as if the interest rates will continue to rise, cap rates will go up, and valuations come down. Then we look at the business plan as, what can we do to this property to generate additional NOI? And the NOI that goes up, the more we can generate NOI, the higher the value becomes. And so we put all that back together in our mixing bowl, which is our underwriting tool that we use, and see how that works out. Another component of what we're doing to prepare ourselves for those unknowns, as if the market was going to go really bad for us, is we put enough reserves in the bank in cash in order to cover for those situations where we need additional cash to pay to keep the property operating, to cover those potential losses. Our whole plan is to first protect the asset and second, deliver a business plan that yields strong returns for our investors. And that's how we approach the Armageddon scenario, is if interest rates are on the rise and we see a recession and the valuations start to decrease. So we prepare ourselves in our underwriting for that scenario. On top of that, in that recession situation, what would likely happen is renters will start to scale down from an A class to a B class to a C class type property in order to pay less rent. They're trying to reduce their costs. And as they reduce their costs, they're going to fill up properties that we're trying to acquire, which means occupancy goes up. Now, that's not a bad thing, but it's not necessarily a good thing either, because in the event that a recession takes place, our property will start to fill up, maximizing occupancy, but we will not be able to raise rents as fast as we would like to in a recession. In fact, we might have to give some concessions just to keep people in the doors and keep income going. That's just traditionally what usually happens. So it's not a bad thing that we're having high occupancy. The only difference is we'll have a challenging time driving additional income growth because we're in a recession. So we prepare for that when we look at our underwriting to make sure that the deal will still be protected in the event that interest rates continue to rise, there's a recession, and that we can still deliver a healthy return to our investors. A second scenario is, let's just say nothing happens. The Fed stops raising rates, everything stays right where it is. Inflation stays right where it is, and there's just no change. Well, one of the things that we're going to run into is we're going to have a challenging time with rising growth in income, as if we did nothing. But on the flip side, current valuation on the property, as we increase NOI, will actually be a positive return for the investment. And that's because we're not, what we assumed would be a loss in value, rising cap rates on our business plan. Those rising cap rates just wouldn't happen. And because of that, 25 basis points or 50 basis points on an increase in cap rate could equate to millions and millions of dollars. And those values would actually be rewarding to us because of market conditions, and that we plan for a scenario where valuations would go down over time. So it wouldn't be a bad thing if everything remained the same for the next 5 years and there was no change. We'd actually come out better than what we originally planned in our underwriting when we look at deals. Now, we look at the market consistently, daily. We're watching the interest rates. We're watching what the government policies are doing. We're watching what's happening to industry and the markets we're buying. Are there jobs being created? Are there jobs being lost? So that we can make sure that we're preparing our underwriting to fit with what we're expecting and we're seeing is happening in the marketplace. Now, on a great side, let's just assume for a moment, we don't do this when we do our underwriting, but let's just assume for a moment that interest rates start to come down. In the next 12 to 18 months, all of a sudden the Fed says, hey, listen, things are starting to get better. The economy is getting better. We need to start lowering rates because it's too high. So let's just start notching down rates. As interest rates lower, that means the cost of borrowing money to buy an asset becomes cheaper. And that results in a rise in value. So my cap rates will start to shrink. And as cap rates start to shrink, our valuation will go up. And that is extremely beneficial if that were to take place. We don't plan for that, but the flip side, as if the economy starts to get better, cap rates come down, interest rates come down, that gives us even more options to exit the property. We can sell, we can refinance, or we can just continue to hold and cash flow. Because as that cap rates start coming down, that means the value of the property goes way up. As the value of property goes way up, our cost to borrow for a refinance comes down, and we can take more cash out of the property to put it towards something that's going to generate additional revenue. Or we can just sell the property, absorb those high profits, and go look for another opportunity. So we have a lot of different options as the economy gets better, cap rates come down, interest rates come down. it just makes things so much easier, but we don't plan for that. We assume that they will come down at some point, but in our underwriting, when we look at deals, we make sure that we are looking at a conservative standpoint as if the economy is going to go for the worse. And if the deal that we're purchasing can sustain itself and protect our investors' money as the economy gets worse or the property gets worse or the market gets worse, then we know that we have an opportunity here. So each market cycle has its unique characteristics. And regardless of which market cycle we are in, we are preparing for the worst on the back end, so that when we look at buying this asset, investing in this asset, putting time and effort in this asset, that asset will result in a positive return if the market shifts the wrong way. So hopefully that gives you a good picture of how we look at the economy and how we underwrite properties and what our methodology is. Because regardless of any cycle, we're assuming we need to be conservative and that the market's going to shift the wrong way. And we protect the asset first and foremost, and second, yield those high returns. So have a great day, everybody, and we'll see you again soon. Thanks.